Gold has slipped from its record highs of a couple of weeks ago, but our guest says bullion has a good chance of outperforming the S&P 500. He says it's done so this century, over the past 25 years. Lyle Stein joins us now, president of Forvest Global Wealth Management. Lyle, it's great to see you.
Good morning, Andy.
Give us your case for gold here, please.
Well, it's really simple, and it's not just a gold case. At Forvest, we're global investors. We have to look at currencies and markets all around the world. And one of the trends that we see is the U.S. dollar, after having a great run, is now looking like it's giving up the ghost. You're seeing it in the context of trade is a big example. The ability of the U.S. dollar to be the go-to in transactions globally is coming under question. As that happens, as the U.S. dollar falls, then the question is, where does one go? Where does one put assets in a client's portfolio for safety as well as growth in a world where the U.S. dollar is rolling over? And we have a chart that actually shows how the U.S. dollar has behaved over this period. And then...
What period is that?
Oh, sorry, over the last 25 years.
Okay,
so let's look at this chart. The white line is the trade-weighted U.S. dollar. Okay. And you can see how it declined for the beginning of the decade all the way to the financial crisis. It took on strength, it went up, and it went up from 2009 to 23, but now it's beginning this rolling over. We don't see it like a collapse of the U.S. dollar or anything like that, but it's losing its oomph as the global trading currency. So where do you put your money? And this was an interesting piece, the blue line. The blue line is gold, or S&P 500 divided by the gold price. In other words, what does the S&P 500 buy in gold? And it tracks that pretty well, that exchange rate up, down, well, down, up, and down, and it's doing the same thing. Why? Well, gold is now behaving more like a currency than it has at really in a long, long time. I'm not going to say ever, because who knows ever, but in a long, long time. So with that gold to S&P ratio, gold stocks do okay. Gold does okay. It's a better diversifier in a portfolio than the S&P 500. And in this period of time where U.S. interest rates are some of the highest in the world, we can see the U.S. dollar taking a little bit more gas off the accelerator.
Presumably when and if the Fed gets around to cutting interest rates again, if they do, that will tend to lift gold, because low real rates are seen as great for gold.
Exactly. Exactly. And the Fed is in a real pickle, because if they cut rates too fast, inflationary issues coming from tariffs and other things. I mean, the economy in the U.S. is doing okay. But if they raise rates, that wipes out the financial side of things. And what the Fed is most concerned about today is the illiquidity in the U.S. Treasury market. And that's another consequence of the declining U.S. dollar. When I'm speaking about illiquidity in the U.S. Treasury market, why did Trump on Wednesday changed his policy so dramatically for Monday? The equity markets were down, but he was getting stories that the U.S. Treasury market was suffering a heap of pain. The Fed didn't necessarily intervene hard, but the Treasury had to come in. Same thing happened in the pandemic.
So, sorry, when you say illiquidity, people just don't want to trade in U.S. bonds?
The bid-ask spread widens, and as that bid-ask spread widens in the global investment risk-free asset. When you ask any global investor, what's the benchmark? It's the 10-year Treasury yield. It's been the go-to yield. It's been the safe place to park money. And when that bid-ask spread widens, that means there's imbalances in the system. And that happened. And it's happened now a couple times in the last few years. And so it's something we're watching closely. Gold will behave better. And then you got all the central banks diversifying their holdings of reserves from U.S. dollars into currency. We just don't see the U.S. dollar being the king of the hill, and then ask ourselves, how do we play it? Gold is a place to be.
I remember reading years ago that the U.S. bond market was so liquid that some participants would buy and sell with no spread. Why would they do that? Because what they wanted was information. They wanted information. They wanted to be in the market, and it was so there was no spread. But now, I mean, that could be an ominous sign, I suppose, that there's a real gulf in conviction between buyers and sellers.
Well, it's hard to say. I mean, when I say bid-ask spread, it's not like buying a small cap stock on the TSX.
No. Yeah.
But it becomes very difficult to sell when the spreads widen, and because there's no natural buyers. And you hear of hedge funds that are levered 20 to 1 or 30 to 1.
And they hold a lot of U.S. bonds,
They
I
hold
think.
a ton of U.S. bonds. If they ever hit the sell button all at once, you're going to need a central bank to intervene. And that's the kind of environment when you're running money for clients to protect their assets, we have to be aware of. I'm not saying back the truck up, but we have on gold or gold equities.
Yeah.
But nonetheless, there's more room in your portfolio today as a diversifier than there has been really at any time in the last 15 years.
Lyle, thank you very much indeed.
Good to talk to you.
Lyle Stein, president at Forvest Global Wealth Management.